Well, HDFC Bank, which is the largest private sector bank in India, came out with its Q3 FY22 numbers over the weekend. And while the numbers were pretty much in line, the growth has been good for the bank. So revenue jumped 12% on a year-on-year basis, reaching the 26,500 crore mark. Net interest income now coming in almost at 18,500 crore. That's a 13% growth year-on-year. And the PPOP, which is pre-provisioning operating profit, came in 10.5% higher at over 16,500 crore. When we look at provisions immediately after that, and let's look at the provision trajectory as well. Provisions had come in just below the 4,000 crore mark in Q2 of FY22, and this time around it's come below the 3,000 crore mark. So a significant downtick in terms of the provisions made by the bank, and that looks good because that impacts both credit costs as well as profitability. Let's talk about credit costs for a bit. Credit cost was at 1.3% in Q2 of FY22. That's dropped down to 94 bips in Q3 of FY22, and that means that it's at 0.94% versus 1.3% on a sequential basis. That's a large gap. And the management had a bit to say about that as well. So the management said that typically the range of credit cost has been between 1 to 1.2%. However, of course, due to COVID, that had accentuated. It was at 1.2 to 1.3% during COVID times, but that has, of course, dropped significantly due to improvement in circumstances, and that over the longer term will remain between the 1 to 1.2% broadly, given the historical data available with the management. That's how the management plays it. When we look at profit after tax, which is of course the second consequence of lower provisions, that's coming above 10,000 crore. In fact, at 10,300 crore, seeing significant uptick, 18% growth in bottom line. Now, HDFC Bank at an annualized level is probably making 40,000 crore of profit almost every year. So that's a very important number that they've breached 10,000 crore mark. And when we look at the core NIM, that's come in pretty stable at 4.1%, and ROAs have gone up significantly. In fact, 6 basis point improvement on a quarter-on-quarter basis in ROAs, and that has now breached the 2% mark. That is significant, both even from an ROA standpoint. The other data that's of course coming, which is earlier in the month, has been on deposits and advances and CASA. So we'll just speak about it briefly. Advances grew 16.5%, deposits grew over 13.5%, and CASA grew 25% almost on a year-on-year basis. CASA ratio now stands at 47.1% versus 43% a year ago. So that's a 400 basis point, 4% jump there in the CASA ratio itself. So a strong set of numbers broadly when we look at it. In terms of the capital adequacy as well, that saw a significant uptick as well. It's gone up to around 19.5%. With regard to growth, the management had to say that they continue to grow the franchise well. They believe that there is still enough window for growth. They believe that loan growth as well as market share for the bank has expanded. In fact, they believe the bank has a market share of 25% of incremental loans made over the last year to 2 years. So broadly, they believe that HDFC Bank is still a good story with regard to growth. And within it, CRB, which is commercial rural banking, has grown really well. And that is 1/3 of India's GDP. And they believe that that story will continue to grow well. So broadly, good management commentary, good set of results, of course, in line. So it was pretty much expected. We'll obviously have to look at how markets respond to these results.